Our Outlook series, Finding Equilibrium in 2021, continues with my guest today, who is one of the most widely respected voices when it comes to gold and all things relating to the Fed. So I will be asking him, what are the consequences of the staggering increase in U.S. money supply and what's happening behind the scenes at the Federal Reserve? Please welcome back to the show the best-selling author of Currency Wars and his upcoming The New Great Depression, Jim Rickards. Jim, always a pleasure to have you on.
Thanks, Daniela. Great to be with you.
So I want to start by talking about U.S. money supply, which has gone up more in 2 weeks. That's over $700 billion to be exact, than in the 6 weeks during the pandemic. It's the most aggressive we've seen in U.S. history. So Jim, why is no one challenging the Fed about this?
Well, the main reason, Danielle, is people don't understand the Fed. They don't understand monetary policy. And by the way, the elites like it that way just fine. The average American probably thinks Federal Reserve is a brand of, aged whiskey or something. So, look, you understand it. I understand it. The Board of Governors understand it. Actually, they don't. They're not very good at what they do. But there's some experts and analysts and some members of Congress who do. But that's about it. This is not. The creation of money is one of the great mysteries. It's actually not that big a mystery, except it is because people don't know how it works. So they're not held to account. They're also technically independent agency. The regional Federal Reserve banks in the U.S. are privately owned. They're owned by banks in the area. If you said who owns the Fed, I would say Bank of America, Citi, Wells Fargo, and JP Morgan, and a bunch of other banks. The Board of Governors are appointed by the president, but there's actually a vacancy at the moment. That's more inside baseball. So that's the problem. It's not well understood. Now, for those who do understand it, they have increased the money supply radically, but it really doesn't matter very much at this point because there's no velocity, there's no turnover of money. We can talk more about that.
Okay, so that's a good, explanation of it. But let's talk about the consequences of this excessive money supply, Jim. What does it mean for, the average American here?
Okay, well, right now, it doesn't mean anything. Now, that may not be true, a year or two from now, but for now, it doesn't mean anything. And here's why. The Austrian economists, the neo-Keynesians, the monetarists, they all agree on one thing: that's if you create money, you're going to get inflation. Increase in money supply will be an increase in prices, et cetera. That's not true. It's empirically not true. Just go back to 2008. In 2008, the Federal Reserve balance sheet was $800 billion. Today, it's about $7.5 trillion. Even as late as 2015, it was $4.5 trillion. Where's the inflation? We don't have it. So that means that money supply does not correlate to inflation. The key to inflation is a serious problem, or will be, but the key to inflation is not money supply, it's velocity. It's the turnover of money. And the problem right now, are they creating money? Yeah, they're creating it like crazy.
Right.
But all they do is they give it to the banks to buy treasury notes. That's how they increase the money supply. They stick the treasury notes on the Fed balance sheet and they just sit there. The banks have the money. What do they do with the money? They give it back to the Fed in the form of excess reserves, and they get a little bit of interest on it. But the money doesn't go anywhere. It's the lending, the spending, the increase in basically the turnover of money that could give you inflation, but we don't have that. Why? Because people are scared. They're, if you lost your job or your business shut down, you're not spending. You're either paying down debt, you're paying bills. But when you pay bills, that's not spending. That's just reducing your balance sheet. Spending is like going out and buying dinner or Christmas presents or a new car or something. People are not doing that with very few exceptions. So, and the banks aren't really willing lenders at this stage, except to certain sectors. So you're not getting the lending and spending, you're not getting the turnover, and therefore you're not getting the inflation. The money is just piling up and it's not going anywhere. So for now, the increase in the money supply doesn't mean anything. That could change, but we have to watch for that.
But Jim, I'm sure a lot of comments will come in saying, Jim Rickards, have you not gone out grocery shopping lately? How could you say inflation isn't here yet? Are you speaking about inflation amongst all sectors here, or?
Well, but that's how the Fed measures inflation. That's how economists measure inflation. So, okay, grocery prices may be up. I don't dispute that. But TV sets, computers, laptops, prices are going down. Tuition is actually going down, believe it or not, after going sort of straight up for 30 years. So you can't just look at a quart of milk. Yeah, if you're out to buy a quart of milk, you might notice the price went up. But when you look at everything else, clothing, I mean, they're practically giving it away. And that is how they compute CPI. As you know, it's a basket, and it's got groceries, but it's also got clothing. Gasoline at the pump is going down. So people, psychologically, people tend to dwell on the number of prices that they see going up, and they ignore the price decreases. But again, clothing's a big item. It's, as I say, they're practically giving it away.
No, that's a very, very good point, Jim. And how about if you say we're not going to feel the repercussions of the money supply yet? How about other asset classes like gold? Would it get a bouncier because of this increase in money supply?
Well, gold is getting a bounce, but it's getting a bounce for other reasons. First of all, you're right about gold, Danielle. It's when people say, is the dollar going up or the dollar going down? They look at the euro US dollar cross rate, or they look at the dollar yen cross rate, et cetera. And I tell people those measures are meaningless because, if you're in the export-import business, you care about the foreign exchange rate. But all the major currencies, the 7 or 8 major currencies that make up the IMF Global Reserve Report, they're all passengers in a lifeboat. They're all survivors in a lifeboat. Some may be taller, some may be smarter, whatever, but they're all in the same boat. They're all going to sink or survive together. The only way you can understand what's going on in currencies is compare it to gold. And so when the dollar price of gold goes up, I just say, well, that means gold doesn't change. It's atomic number 79. It's an element. It's the same thing. If the dollar price of gold is going up, that means the dollar is getting weaker. If the dollar price is going down, that means the dollar is getting stronger. So if you want to forecast gold prices, you have to ask yourself, is the dollar getting stronger or weaker? And then that will give, that's a pretty good basis for making a forecast. But the difference between gold and all the other currencies is gold, of course, is the only one not printed by a central bank, not subject to manipulation as a supply. There is new supply, but new supply has been static at about 300 metric tons per year for the last 5 years. So that's not expanding dramatically. And that's a very small, it's about a 1.6% increase on the global above ground supply. So that's not a big number either. But gold is your thermometer to tell if the patient is sick or not, the patient being the dollar.
What about JP Morgan's recent report coming out saying that Bitcoin is in fact hurting gold right now? We've seen tremendous inflows in Bitcoin ETFs and major outflows out of gold ETFs.
Yeah, the gold Bitcoin comparison is a straw man. It doesn't mean anything. That's typical Wall Street research, which I pretty much ignore. I look at good research, but I don't put Wall Street in that category. Here's the thing. Bitcoin and gold are both going up because of concerns because of loss of confidence in the dollar. So I don't see a Bitcoin gold trade-off. I mean, first of all, the numbers don't add up. The total market cap, I understand that Bitcoin in percentage terms has had a great run in 2020. It's gone from about $9,000 to $20,000. That's a 100% increase. I get that. But the entire market cap of Bitcoin, if you took all the Bitcoins in the world times $20,000, it's not that much. It's certainly tiny compared to gold, and gold is tiny compared to the foreign exchange market. So there's no, it's not like a zero-sum game and people are getting out of gold and they're going into Bitcoin. That's not happening. What is happening is that people are getting into gold and into Bitcoin at the same time because they want to get out of the dollar.
Jim, you've written numerous best-selling books. In all of them, you've had some sort of forecast or prediction, which unfortunately has panned out, I guess you could say, unfortunately. So I want to take a recent synopsis or tweet you put out. COVID will fade, and not soon, but eventually. The economy will recover, not quickly, but it will slowly recover. What will not fade soon is the new depression. The effects will be intergenerational. This is the topic about on your new book, The New Great Depression. Tell us about it.
Well, I'm happy to, and thanks for the invitation. By the way, I don't usually do stuff on camera. It's called stage business, but I just happen to have a copy of the book.
It's my first time seeing it.
Yes, thank you. It's The New Great Depression, Winners and Losers in a Post-Pandemic World. Uh, the official publication date is January 12th. It's available for pre-order now on Amazon, Barnes & Noble, and Powell's and other sources. But you're right, Danielle. In my last book, Aftermath, came out in July 2019. If you look at pages 280 to 295 in that book, I talk about a pandemic and a couple other events. And I say there's a 100% chance that one of them will happen in the next 3 years, and pandemic is on the list. And then I said that will lead to social disorder, riots in the streets, and armed forces, whether it's militias or U.S. National Guard in the streets. So nothing happened in 2020 that you weren't warned about in 2019 in my last book. In my new book, it's the same thing. I just take the story forward. So we're in a depression. Depression does not mean continuous declining GDP. It means depressed growth. We'll get growth, but it will be below trend, even worse than the 2009 to 2019 expansion, maybe growth of 1.7%. But right now, right this minute, we're going into a second recession. Recessions are technically defined 2 consecutive quarters of declining GDP. So we had a recession from February to July 2020. We came out of that recession because we had very strong growth in the third quarter. But now we're going back into a second recession, the first back-to-back recession since 1980, 1981. And the reason is obvious, which is we're going back into lockdowns. There's another coronavirus outbreak. By fatalities and daily case reports, it's worse than March and April. If you say, well, look back at March and April, how horrible it was. Well, it's worse than that right now. It's the interesting thing about the book, Danielle. It'll be the first book, and so far the only book, that wrestles with the pandemic and the economic outlook. Doctors are going to write books about the pandemic. Economists will eventually get around to writing books about the economic state of affairs, although economists tend to prefer papers to books. But this book tackles both head on and draws the linkages between them. And the main linkage, so here's the pandemic, here's the depression. What's the link between the two of them? The answer is it's the lockdown. Lockdowns don't work. They're unnecessary. There are things you can do. There are better things you can do that are more effective and less expensive, but that's not what the politicians want. But we're in a new lockdown right now, so you're going to get a new recession. This is one of the easiest forecasts I've ever done. First quarter of 2021, you're going to have a recession. These stocks are going to back off. Don't worry about inflation. You should be more concerned about deflation, which is coming. And gold will do very well in that environment because of the political and economic uncertainty. And also, we're going to get declining interest rates. So lower interest rates is a tailwind for gold. Political uncertainty is a tailwind for gold. So gold should do very well starting now going into 2021.
So to that point, Jim, would you be out of U.S. equities now, and would you be buying more gold? And if so, how much should someone allocate to their portfolio?
Yeah, the worst thing you can do in any asset class is go all in on anything. Diversification is the key. Most people don't understand diversification. They think if they own 30 stocks in 10 sectors, they're diversified. And I say, no, you're not. You've got one asset class, okay, and they're highly correlated. So I wouldn't get all out of equity. I would lighten up on equities. I would increase my allocation to cash because cash reduces volatility in your portfolio. And I would absolutely have 10% of investable assets in gold, silver, or gold mining shares. Now, some people say, well, Jim, if that's the way you feel, why not go all in? Why not 50%? You know, that's up to you. I don't recommend those kind of high percentages. You don't need them. If I'm right about the price of gold going to $10,000 to $15,000 an ounce in the coming years, a 10% allocation is going to do just fine. That's going to save your portfolio.
Just getting back to your point, and we can wrap on this good quote of yours here, Jim, of your book blending and the economic with the medical aspect.
Right.
I just wanted to take one quote where you say the destruction of over 4 trillion in asset value and the loss of 2 trillion in economic output was the cost of the lockdown. The doctors exceeded their authority and the politicians failed to stop them.
Correct.
Ouch. So you don't put words in this book.
That's a pretty good assessment. Because so you got guys like Anthony Fauci. He's the head of immunology of the CDC, Centers for Disease Control, And he's just like a near 80-year-old bureaucrat, swamp creature who's been around forever. He's held out as this prominent immunologist. He's not that good. There are prominent immunologists. You can find them at Rockefeller University or Stanford or elsewhere, but not in the U.S. government. So he's a guy who said, don't wear masks. And he said, wear masks. And he said, we'll get through this. Oh, it's really bad. So he's just a bureaucrat. And he likes to say, well, we don't determine economic policy. We're just doctors. We're just
Right.
giving advice. That's not true. They took over the economy. Now, I fault President Trump for allowing that. Trump did a lot of things right, but that was one of the big things he did wrong. He put the doctors in charge of the economy, and doctors complain, and I'm going to get this criticism on my book. I can see it coming. Well, hey, Jim, you're not an immunologist. What do you know about medicine? Well, I turn around to the immunologist and say, what do you know about the economy? The answer is nothing. The old saying, Danielle, if you're a hammer, everything looks like a nail. If you're an immunologist, everything looks like a lockdown. No one, actually Melinda Gates came out and said this, another, bubble creatures like, living in her elite bubble and completely out of touch with the real world. She said, well, when we said this lockdown thing, we didn't really quite think through the impact on the economy. It's like, well, duh, you lock down the economy, you're going to get 60 million claims for unemployment, which is what we've got. But the question is there something you could have done that would have been as effective at a much lower cost? And the answer is yes. The simplest, washing hands, wearing a mask, social distancing, and maybe canceling big crowd events, like football games, whatever. If you just did that, you would have had the same effect, same benefit of a lockdown at a much, much lower cost. We didn't have to shut down bars, restaurants, salons, dry cleaners. That's 50% of the economy. It's 45% of jobs. We've destroyed the economy for no good reason because, every other seat in the hair salon and wear a mask, that works fine. You don't have to close the place. But what you had were elites, rich elites, and government bureaucrats out of touch with everyday Americans. And I dare say, same thing in Canada with your prime minister up there, who, they were on effect. They've got places to go. They can work from home. They've got plenty of money. They're not worried about job layoffs, least of all government bureaucrats, but they crushed everyone else for no good reason. And that's all covered in the book.
Wow. New Great Depression. Sounds like another winner on your hands. Jim, I wish you best of luck with it. Come back for the official launch. And I want to take this time to wish you a very Merry Christmas, Jim.
Thank you, Daniela. Merry Christmas.
Thank you. And thank you for watching. Our Outlook series will continue, so be sure to stay tuned to Stansberry Research. Thank you for watching. I'm Daniela Cambone.